I want to quickly talk to you about how to get a loan for a new small business. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Studio Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as superb as I am, go grab a cup of coffee or a tea or vodka and let's roll. In today's conversation, I want to talk to you about how to get a loan for a new small business. And I have 10 steps for you, 10 easy steps. Step number one, you want to clean up your personal credit report. Of course, we're talking here about a business loan, but because your business is new, because you have a startup, a lot of lenders will rely more on your personal credit report. So you want to clean that up. And there are a couple of things you can do. First, you want to pull your credit reports. Under the Fair Credit Reporting Act, you are entitled to one free credit report every year from each of the three major credit reporting bureaus. So I'm referring to Equifax, Experian, and TransUnion. So if you rotate through the bureaus, that means you can get a free credit report once every 4 months, helping you be aware of any issues or problems that you need to deal with in a timely manner. Okay? And so once you get the credit report, you want to go through them, and you want to go through them line by line. This can be tedious work, but guess what? It's worth it. Because especially if you have a long credit history, it's important to thoroughly check your credit report each time you pull it. You want to look for things like loan statuses, account balances, your payment history, the list of recent credit inquiries, and anything else on the report for accuracy. Very important. And you should also pay attention to your personal information, even though it doesn't directly affect your score. Okay? Unfamiliar line items such as the wrong address or an incorrect birth date could be a warning sign of identity theft. If there are errors, you want to challenge the errors, right? You want to contact the bureaus, you want to write them, or if you have the budget, or if the error is big, you can contact a credit repair service that can help you. There are some that work pro bono, and there are that charge for the service. You also want to try to get past due accounts of your reports. You also want to think about lowering your credit utilization ratio, your CUR. That's actually the ratio of how much credit you are using to how much you have available. So in general, the lower the CUR, the better. And using too much of your available credit indicates that you might be relying too heavily on credit cards for daily living expenses, which makes you a bigger credit risk and lowers your credit score. And you also want to take care of outstanding collections. This is very important. Step number two, I want you to know startup loan requirements. If you want to get a loan for a new small business, you need to know the requirements. Now, those requirements generally vary significantly by lender, but you should be prepared with the following. So an updated business plan with details on your growth and marketing strategies. I'll speak at length about the business plan later on in the show. And you also want to think about personal credit reports and scores from all three major credit bureaus. I have spoken about that before, so you want to have an idea of what's on those reports. Mind you, the lenders themselves will also obtain their own copies, but it's great for you to check first. You want to think about business forecasts with details on future cash flow and cost. Very important. When we talk about a loan for a small business, the lender is paying attention to cash flows, not revenue, not accounts receivable, not sales. They're paying attention to the cash flows, because you might have sales, you might have $1 million worth of sales on the books, but if the customers, if they're not paying you on time, you might have a cash flow problem. You might have a liquidity problem. And you also want to think about tax returns and supporting IRS documents for both your business, if available, and personal tax accounts, including personal documents for all owners or registered agents of the business. Any applicable licenses and registrations for doing business in your states, any financial documents that will be deemed relevant, including bank statements, credit card sales, unpaid invoices, and accounts receivables due to you if available, and any legal contract that will be relevant. I'm talking here about franchise, incorporation, leasing. So the whole idea here is to understand the business loan requirements so that when you are ready to apply, you have a competitive edge, if you will, and you are able to get things done quickly. As a startup business, you may not have business credit reports or even business tax returns. In that case, the lender may rely on personal credit, tax returns, and or a personal financial statement. So it's very important to know. So if, however, you are purchasing an existing business, the lender will require likely information about that business. So once you have submitted your application, you may have to be patient because some funding options can be approved within minutes, especially the online ones, but some may take weeks or even months. Step number 3, folks. So step number 1, you want to clean up your personal credit report. Step number 2, you want to know the startup loan requirements. Number 3, you want to comply with business laws. And here, there is a constellation of criteria you need to pay attention to, folks. First, you want to have the proper business structure. I'm referring to things like LLC, LP, S Corp, C Corp, sole proprietorship. It's better if you want to get a loan for a new small business. It's better to have a proper quote unquote corporation structure. For me, based on our analysis, we believe it's better to opt for an LLC, a limited liability company. There are a lot of pros and a few cons, but it's better. If you choose a sole proprietorship, you might be limiting yourself in terms of the amount of loan you will be getting. You need to get an EIN. EIN stands for Employer Identification Number. This is very important in terms of complying with federal as well as state tax laws. So you need to think about state tax compliance, sales tax, paying employer taxes, paying all kind of income taxes at the state level. You also need, in terms of business compliance, you need to think about licenses and permits. Those vary significantly based on the industry you're in, based on the states where you're located or the states where you're doing business. You also need to think about insurance, including workers' compensation insurance and general liability insurance. You need to have those elements to actually tell the lender that you are complying with business laws and that you are a legit business, right? Because lenders are thinking about risk management. They're thinking about risk. If you are a new business and you have no sales history, no revenue history, you better be legit. You better do things properly to at least alleviate the concern that the lender has that you might be out of business very soon. So they're giving you their money. They want to make sure that you have some parameters, you have some safeguards in place to protect the business should things go wrong. So think about insurance as a risk management tool, as an important risk management tool. You want to separate personal finances from business finances, and you can do so by having business credit cards, business bank accounts, and so on and so forth. You also need to set up accounting and financial reporting. This is very important. You don't have to you don't have to hire an entire team of accountants. You can actually just sign up for a service like QuickBooks Online or Zoho or Xero or Wave, and it's pretty free or affordable. Step number 4, folks. You need to create a business plan. So step number 1, clean up your personal credit report. 2, you want to know the startup loan requirements. 3, you want to comply with business laws. Step number 4, you need to create a business plan. And a business plan is something that has become commonplace nowadays in terms of business loans, business loan requirements. And there are generally 6 or 7 sections of a business plan. So you have the executive summary. This is a concise overview of your business plan. It should be short and must be well written, because your goal here is to draw readers in, including lenders in, so they want to learn more about your company. Then you have the company description. This is a high-level view of your business, which explains who you are, how you operate, and what your goals are. You need to talk about the products and services. You need to clearly describe what you're selling with a focus on customer benefits. You want to include details about suppliers, products, or service cost, and the net revenue expected from the sale of those products or services. You want to think about also you want to do some market analysis. This is where you show the lenders your industry knowledge and you can present conclusions based on thorough market research. You want to place detailed findings on any studies in an additional section, appendix, right? You need to talk a little bit about strategy and implementation. This is where you actually recap your sales and marketing strategy and how you will implement them with an operating plan. Number 6, you need to have an organization and management team section. This is where you outline your company's organizational structure. You identify the owners, the management team, and the board of directors, if applicable. And the number 7, you need to talk about the financial plan and projections. So you are actually telling the lenders how you are going to use the money, what kind of revenue you're projecting, what kind of expenses you're projecting. And mind you, though, if writing a business plan is not your forte, you can outsource the task to a local business consultant. You can go online to sites like Fiverr, Upwork, and Freelancer to hire a business plan writer. You can even get business plan software, such as LivePlan or Small Biz. Okay, I'll be right back. After this, don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweet Kiwi Show. We are still having a conversation about how to get a loan for a new small business. Step number 5, you need to explain how funds will be used. In the last section, I was speaking to you about business plan and where you have a section called financial plan and projections. This is kind of cool when it comes to showing revenue and expenses. But now you need to explain specifically how funds will be used, and you need to determine how much funding you need, right? And so this kind of will compel you to create something called a sources and uses of funds statements. This is actually it's basically what it is. So as you can tell from the name of it, a sources and uses of funds statement shows the reader or lender the information needed to get the big picture of the uses of funds and the sources of funds. So uses of funds, this is the money needed for various purposes for business startup, including beginning quantities of supplies, equipments, and furniture, the purchase of a building and land, initial startup cost for rent, deposits for rent, initial payments for insurance, and other working capital needs. And the sources of funds include things like sales of assets, owner contributions, sale of stock, and cash income. And I want to show you right now on the screen here, you can see a simple sources and uses of funds statement. You can see that here. And you see on one side, you have the facility cost, equipment and vehicles, supplies, and advertising, other startup costs, and the total startup costs. Of course, you need to add the working capital, and this amount to $750,000. And on the right side, you have the sources of funds, including the owner collateral coming from IRA, 75 grand, the owner savings, 25 grand, home equity, 50 grand. So the total collateral posted by the owner, 150, and total to be financed, 600,000, which brings the total sources of funds to 750. And so this is just a sample, but the whole idea here is to explain to a lender what the money will be used for. And you are able you're able to pinpoint exactly how much you need. And this is very important. It's not about just saying, oh, I need $1 million. Okay, for what? Why do you need 1 million and not $500,000 or 10 million? You need to elaborate and substantiate all this. Number 6, folks, you need to understand lender's perspective. We've seen in our analysis a lot of small business owners making mistakes about understanding really what the whole loan process is and understanding the language that lenders speak. You need to look at a startup business loan from the lender's perspective. A lender thinks about your business this way. How risky is the type of business you are starting? What is your experience or expertise? What is your credit history? How quickly will the business become profitable? If the business were to fail, is there equipment or assets that can be liquidated? So if you craft your business plan correctly, you can answer many of these questions properly. And so once you understand the lender's perspective, you need to identify which type of a startup financing you'd like. And before gathering documentation for your business, you need to know what the lender will be looking for. The application for let me give you an example. The application for a microloan will likely be very different from that of a business credit card or that of a term loan from a traditional bank. So you got to think about the lender's perspective. You got to think about the lender's risk management strategy here. And you also need to remember what you can afford. And this is basically based on your financial plan in your business plan. So you have an idea of how much you can afford in terms of your budget. Because knowing what you can afford for monthly payments can help you best narrow down what financing products you are interested in applying for. So when you've pinned down a loan type and lender, you can then begin to fill out the application. All right. And number 7 here. Number 7, I want you to consider local lenders. If you're not lucky with traditional lenders at the national level, try to form a relationship with local banks, credit unions, and savings and thrifts. Because even if your business might be new, those financial institutions, they know you more at the personal level. You probably have a personal account, checking account, or savings accounts with them. You've had that for many years. They've seen the ins and outs of your business transactions, of your personal transactions. They've seen the cash flows and cash outflows, the cash inflows and cash outflows. So they are more likely to look at your business loan application more thoroughly and more broadly. Step number 8, folks, you need to know all startup loan options. So if you are looking for a loan for a new small business, you need to understand there is a whole constellation of small business loans available out there. A lot of times when people think about business loans, they only think about bank loans, like term loans, but you do have other loans. For example, you have equipment financing. This is actually the kind of financing that helps your small business pay for the purchase of equipment and machinery. And the monthly repayment terms are set over a period of time. And so this is what falls under the category of asset-based lending. You also have business credit cards. For example, if you can't get a loan, some credit cards actually might be able to help you. And some credit cards even offer a 0% introductory rate offer. So you can use the money for free, quote unquote, for free for one year or 2 years. This is really, if you think about it, it's kind of similar to a loan, right? You also have the SBA 7A loans. So for the most part, the SBA doesn't make loans, it guarantees them. So individual lenders are approved by the SBA to make loans under SBA program. Okay, and there are several different types of SBA loans, and among the most popular is the 7A program, which offers loans up to $5 million. You also have the SBA microloans, right? Those are made by approved intermediaries and often community development financial institutions, the CDFIs, and other nonprofit organizations. And the amounts there, the amounts of microloans are capped at $50,000. And according to research, the average loan is closer to $15,000. And an SBA microloan is a term loan with a maximum term of 72 months. And you also have to think about other microlenders. You have microlenders such as Acción and Kiva. Those are two nonprofits lenders. And with Acción, loans are available from $300 to $250,000 through the Acción's CDFI partners. And for Kiva, you're looking at a maximum of $15,000. You also have to think about invoice financing. This is kind of cool also, right? And also crowdfunding. This could be another option. So popular crowdfunding platforms like Kickstarter and Indiegogo allow anyone with a vision, including entrepreneurs, to raise money for the project or venture. And there are three main types of crowdfunding that may be available to startups. So you have rewards, example Kickstarter and Indiegogo. You have debt, Kiva, and you have equity, WeFunder. Step number 9, I want you to consider online and alternative lenders. And so I actually have four main online alternative lenders that I want to talk to you about. You have Lendio, and Lendio is actually a marketplace that connects your small business with tons of lenders and loans, making it the first stop for any startup. And the application is fast. You have a wide variety of funding and lenders, and you have personal guidance and expertise. That's for the pros. The cons, they have high interest rates on some loans, and they have reports of hard credit inquiries. And then you also have Fundbox. Fundbox is kind of cool if you have bad credit and you are seeking a loan for a new small business. We love the fact that Fundbox has an automated application. Another pros is that you have low approval requirements and you have fast funding. The weaknesses, you have low maximum loan amounts and a high APR. You also have street shares, and this is actually great for peer-to-peer small business lending. And so maybe you've heard good things about peer-to-peer lending, like the fact that you can often get surprisingly low rates. So in that case, you really might like street shares. And while it's still developing, the platform is still developing, they offer great deals on loans. And most importantly, Street Shares is one of the only P2P lenders that startups can qualify for. So if peer-to-peer financing interests you, you want to actually give Street Shares a try. We also have another player we want to introduce to you. You have Can Capital. Can Capital is kind of cool when it comes to MCAs, so merchant cash advances. And we love the fact that they have a great service. They have transparency in terms of the funding process, and they also have a great, I think, reasonable fees for the kind of industry they're in. The picture I'm trying to paint here is that when it comes to getting a loan for a new small business, you have a wide variety of loans to choose from. Besides traditional loans, you can think about alternative loans. You can think about online business loans, online startup loans. Okay. Step number 10, folks, last but not the least. I want you to consider tapping into personal and friends or family funding. Yeah, why not? Personal funding is a viable option and one of the many ways many small business owners access capital. But using personal funds or personal loans is a gamble, and you'll need to do a solid job of calculating all of your costs. Okay, and because the whole idea is that you don't want to run out of money before the business can support itself. Even if you use personal funds to start, we advise you to start taking steps to establish business credit right away. That way, you can start to leverage business credit and access more capital in the future. The business should be able to stand on its own without commingling personal assets and credit. And there are a few different options when it comes to personal funding. So you have personal credit cards, right? So let's say if you cannot secure a business credit card, a personal credit card or two with a reasonably high limit can help you get those first few purchases and your business on the way. You want to keep a close eye on your credit utilization ratio. You want to pay your bills on time, because putting business expenses on a personal credit card can hurt your personal credit scores. Another personal funding option is savings or home equity. Dipping into your savings is an even riskier business, but if you have a good amount of money set aside, this could be the cheapest option for you. Borrowing against your home equity is a cheap option but very risky. You might also want to consider 401k IRA savings, because you may be able to withdraw funds from your retirement plans, borrow against the 401k, or use something called a ROPS plan to shift retirement funds to your business. Keep in mind that this may not be the wisest option, because you don't want to bet your whole retirement savings on your brand new business. And you can also reach out to friends and family, right? Many businesses have been funded with the help of family members. In fact, it's actually one of the biggest sources of startup capital available to early stage businesses, according to research. You also, when it comes to this kind of route, you want to tread carefully. And please do not apply pressure, because you don't want people to actually fund you and regret it. I mean, family can be a good positive backing. They can offer great positive backing for your new venture, but they have to do it intentionally. They have to do it voluntarily. Okay? And another way to approach it is to ask them to be the first backers in your crowdfunding campaign. All right, folks. This was it for today's conversation. I was talking to you about how to get a loan for a new small business, and there are 10 steps you can follow to do that. First, you want to clean up your personal credit reports. You need to know startup loan requirements. You need to comply with business laws. You need to create a business plan. You need to explain how funds will be used, understand lenders' perspective, consider local lenders, know all startup loan options, consider online and alternative lenders, and last but not the least, you want to tap into personal and friends or family funding. Thank you so much for your attention. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.